When we think about defending our wealth, our minds usually jump to some big dramatic event, right? A stock market crash, a sudden crisis. But what if the biggest threat isn't an event at all? What if it's this invisible environment that we're all swimming in and day out, that's quietly eating away at everything we've built? So let's dive into a playbook for how to defend against that, starting with a surprisingly common mistake our own brains make.
The great Yogi Berra once said, "A nickel ain't worth a dime anymore." And honestly, that just perfectly captures this huge psychological trap we all fall into. It's called the money illusion. Basically, it's this fundamental glitch where our brains are wired to track the number of dollars we have, the nominal amount, instead of what those dollars can actually buy. And this one simple bias, it's the root cause of so many investing mistakes.
But how does this money illusion really fool us in the real world? To really see it in action, let's look at a super simple story about 3 different homeowners. Now, on the surface, you're going to think it's obvious who came out on top, but trust me, the reality is way more surprising. Okay, so meet Amelia, Bella, and Charlotte. Amelia sold her house for 23% less than she paid for it. Sounds bad, right? But since the prices of everything else fell by 25%, she actually came out ahead. She had a 2% gain in real purchasing power. Then you've got Bella, who broke even. But Charlotte, now here's where it gets interesting. She sold her house for 23% more than she paid, a huge profit on paper. But because inflation was running at 25%, she actually lost 2% of her real purchasing power. And here's the kicker. Charlotte feels like the richest one of the 3, but in reality, she's the poorest.
And what's so cool about this slide is how it just lays that illusion totally bare. Look, Charlotte saw $615,000 hit her bank account, and she felt fantastic. But the hard reality is, just to break even, just to keep the same purchasing power she started with, she would have needed to sell that house for $625,000. That $10,000 difference, that's the real loss, completely hidden by the illusion of a big, flashy profit.
So getting your head around the illusion, that's step 1. Step 2 is trying to actually fight it. And that brings up the big question. Where do we turn? Let's go on what I like to call a great hedge hunt and check out all the usual suspects that Wall Street tries to sell us as the perfect shields against inflation.
So where does our hunt begin? Well, with the most common advice you'll probably ever hear, just own stocks. And the theory seems to make sense, right? Companies pass on their higher cost to customers, profits go up, your portfolio is safe. It sounds absolutely perfect, but the data tells a very, very different story.
And this chart just brilliantly illustrates the truth. See, stocks have an inflation sweet spot. When inflation is low, say between 0 and 4%, they do incredibly well. But just look at what happens as inflation starts to climb. In that 4 to 7.5% friction zone, performance tanks. And once inflation gets above 7.5% into the double digits, stocks get absolutely crushed, delivering average real losses of nearly 10% a year. So yeah, they're not the simple hedge we've been told they are.
Okay, so if stocks aren't the simple answer, what about the ancient safe haven? Gold has been a form of money for thousands of years. Surely it's got to be the ultimate protector of value, right?
Well, here's the catch. Over centuries, yes, gold is a phenomenal store of value, but over a human lifetime or an investment cycle, it's just deeply unreliable. Look at this chart. In 2021, just as inflation started surging, gold fell by 3.5%. The next year, 2022, inflation broke modern records and gold lost money again. It's a fantastic long-term anchor, but it's a terrible short-term shield when you actually need it.
Fine, let's look at the new kid on the block. What about Bitcoin and other crypto assets? They have a fixed supply, which in theory is the very definition of an inflation hedge. Could this be the digital fortress we've all been searching for?
Well, the data says not so much. Bitcoin was marketed as this ultimate inflation terminator, but in the real world, it acts a lot more like a speculative collectible. When inflation was raging in 2022, Bitcoin crashed by almost 2/3. Then, in 2023, as inflation fell, Bitcoin soared, which is the exact opposite of what a real hedge is supposed to do.
All right, let's quickly check off the so-called safer assets. Real estate? It gets hammered by the rising interest rates that usually come with high inflation. And what about those government bonds that are specifically designed to protect you? Well, things like I-bonds have really strict purchase limits, and they lock up your money. And TIPS, Treasury Inflation-Protected Securities, they have a fatal flaw. They are so sensitive to interest rates that they lost over 11% in 2022, the very year they were supposed to be your ultimate shield.
So let's take a look at the final scorecard from our big hunt. Stocks, gold, TIPS, real estate, crypto, Every single one of them has a major flaw. They either fail in the short term when you need them, they have way too much volatility risk, or they have this fatal sensitivity to other things like interest rates. Bottom line, there is no perfect financial asset to solve this problem.
And that, right there, brings us to the big twist. This whole search for one single perfect asset, it's a fool's errand. It's the false grail. The entire idea is wrong because you can't survive a powerful environmental force with just a single tool. Think about it. To fight an environment, you need more than one tool. You need armor.
So this leads us to a completely new way of thinking about wealth. Instead of hunting for some magic asset, we need to start thinking like an architect and actually build a robust, multi-pillar defense system.
And this is it. This is the wealth architecture model. Think of it like a shield that's supported by 3 critical pillars. First, you have your financial capital. That's your stocks, bonds, cash. Then you have your physical capital, real estate, collectibles, that sort of thing. But then there's the third pillar, the one that most people ignore but is by far the strongest, your human capital. This is the total present value of everything your career and your skills will ever produce.
And that's what we need to focus on. This is your secret weapon in the fight against inflation. And you know why? Because it's the one asset where you have the most direct control over its growth.
A really powerful way to think about this is the "you are an egg" analogy. Your career, your human capital, is the golden egg in your basket of assets. It is your single biggest, most concentrated investment. And you have to manage the risk of that single asset just as carefully as you manage your stock portfolio.
And here is the single most important warning that comes from that analogy. Do not concentrate your financial investments, the other eggs in your basket, in the same industry where your career is already concentrated. If you work in tech, please don't have 80% of your portfolio in tech stocks. You are literally doubling down on a single point of failure.
Okay, so we have a brand new model. Now let's turn it into an actual actionable playbook. This is your bulwark, your defense against that invisible environment.
It really all comes down to 3 simple but powerful principles. First, accept the math. You have to rigorously subtract inflation from all your return numbers and escape that money illusion for good. Second, accept the imperfect. Abandon the hunt for a perfect financial hedge because it just doesn't exist. And third, and most important, build the triad. Your strongest defense isn't a ticker symbol. It is the synchronized protection of your financial assets, your physical assets, and the relentless expansion of your own earning power.
So I'll just leave you with this one question. We spend so much time analyzing stocks and funds and all that, but your most valuable asset isn't in your brokerage account. It's you. The real question is, are you truly investing in it?